Hello, this is John Andrews, bringing you this presentation on the characteristics of options. First and foremost, options give you the right to buy or sell an underlying instrument at a specific price. By underlying instrument, we mean a stock or an ETF or a bond, anything that has options available. You have the purchaser of the option, you control that option, so you're able to control that particular asset, the stock or ETF or bond, with a much less capital, but it does have a time, there's an expiration date on it, so time does work against you, but nonetheless, options give you the right to buy or sell an underlying instrument at a specific price. And number two, options are available on a variety of different underlying assets, including stocks, futures, and indexes. And we trade options on just about anything that moves, I will say. We also trade the grains. We trade futures options, options on the indexes, the stocks. So they are available on a variety of things. So you're not stuck in a particular class or characteristic that are heavily correlated to one sector or the other. You've got the kind of the world is your oyster. That's a huge advantage, the flexibility that options give you. Third point is there are really two kinds of options. I'm sure this goes without saying. There are calls and puts. And you can either buy an option or you can sell an option. Some newer traders have a hard time getting their head around being able to sell an option without owning something. And we're so conditioned to owning something, buying something. That's the easy part. But selling something I don't own, that's kind of strange. But in the option space, you can do that. You can take either side of the trade, be it bullish or bearish, neutral, whatever your bias is. But you can either buy or sell an option. Number four, now if you buy an option, you're really not obligated to buy the underlying instrument. You simply have the right to exercise the option. What does that mean? As an owner of the option, and let's say you buy an option on a stock that's currently trading for $100, and you buy the 105 option on it, and it expires in 60 days, as an example. You pay a premium for that right to buy that stock at that price on or before that day. So if that stock never reaches 105, you're probably not going to exercise your obligation to buy it. Now, if the stock goes to 110, you can buy it for 105, but that's what you pay the premium to do. But you're not, as a buyer, you're not obligated to exercise, even if your option's in the money. It's strictly up to you. Number five, now on the other hand, if you sell a call option, you're really obligated to deliver that stock or bond or future, whatever you sold it against, at the price at which the call option was sold, if the buyer exercises his right to take delivery. So that's the difference between being a buyer of an option and a seller. The buyer always controls the transaction. So the seller is obligated to deliver the underlying asset at the price that it was sold. Now, if you sell a put, you're obligated to buy the stock at the owner if the owner of the option chooses to exercise. Which, again, let's take that $100 stock, and you sold a $100 put on it because you think it's going to go up and you're going to keep all the premium. If that stock goes down and it goes to 95, you're forced to buy that for 100. That's your obligation. That's your contractual obligation to buy that for 100. Now, your cost basis is going to be a little bit lower because perhaps you collected a couple of bucks for that option. But as the seller, you're the one that is obligated, as opposed to the buyer is not obligated. Now, options are available at a number of strikes at or near the underlying price of the financial instrument. So what I mean by this is, if you look at the option chain, there's a plethora of strikes depending on the particular stock. Some have very few, but if you get into more liquid products that are heavily traded, like SPY for the spiders or Apple, you'll see a number of strikes available at the money and beyond, either on the calls or puts, and on both sides, either in the money or at the money, or above out of the money. Now, here's the kicker with options. You do take less capital to control the asset, but they're only good for a specified period of time, because there's a finite time when you buy that option. It has a specific expiration date. After they expire, and that date goes on, there's no more value in there. And the holder, if you're the buyer of that option, you lose the right to buy or sell the instrument at that price. So time is a critical component of options, and one that you want to be keenly aware of. Now, when you buy an option, it's just like buying anything. It's a debit to you. If you buy a $100 option on XYZ company and the cost of the option is $5, you're going to be that one option contract controls 100 shares. You're going to be your account's going to be debited $500. So if you had $10,000 in your account, as an example, you're now going to have $9,500 in your account, but you're going to own that option. Now, when you sell an option, you're actually going to get a credit. So let's take that same stock that's traded for $100 and you sell a put on it or a call, either one, depending on your bias. And you collect that $5. That $5 immediately goes into your account. So if you started out with that same $10,000, now you've got $10,500 in your account. Of course, you're obligated to take delivery of that stock if it gets in the money and the buyer, the owner of that option, choose to exercise you. Now, the cost of an option is referred to as the option premium. And if you think about in the insurance business, they call it insurance premiums that we pay for our insurance coverage. It's exactly the same. A insurance policy, insurance premium covers a specific risk for a specific period of time at a certain price. In the options world, the price is reflective of the volatility is a key component, how much time's left until expiration, the current interest rates, and of course the price of the underlying asset. Now I want to talk a little bit about liquidity in options because I think that's extremely important. Liquidity is a metric showing the ease a financial instrument can be traded. The higher the liquidity, the easier it is to facilitate a trade. So if you're trading something like Apple or like the SPY, something that's extremely liquid, there's tens of thousands of contracts that are traded on it. It's an extremely liquid product to get in and out of. If you trade something, somebody gives you a tip on something and it's got very little liquidity. I call those roach motels. You can get in, but you can't get out. So if you want to be a successful option trader, certainly stay in the ones that provide that liquidity and stay away from those that aren't very liquid. Now, liquidity can be further defined as the volume of trading activity that enables a trader to buy or sell a security or derivative, which is an option, at a fair price where the buyer and seller agree. So you've got a bid and an ask price in options, and on the again, our examples of Apple or SPY, any of the heavily traded ones, you've got a bid side and an ask side, and you're going to find that the spread is what they call the bid-ask spread. The difference between the bid and the ask is very tight. And what that means as a retail options trader, if you want to buy an option, you're going to pay the ask. And let's say the ask is $1. And if you want to sell it, you're going to sell it at the bid, just the opposite of what the market maker is doing. And so say the bid is 98 cents. Now, that's a really tight $2 wide spread on an option. So you could buy it for $1, decide you don't want it, you can sell it back for 98 cents. Very tight bid-ask spread. But those ones that are illiquid, you might buy it for $1 and sell it back. You don't want to sell it back for 5 cents. And that's what you want to stay away from, is those that have really wide bid-ask spreads and don't have a lot of liquidity. If you don't really get your head around liquidity, the real importance of it is that sufficient liquidity will allow you to move in and out of positions without any difficulty. The more liquid the product is, the easier you can get in and get out. And like the illustration I just gave on the last point, if you've got a very tight option market with a very tight bid-ask spread where there's a penny or two difference, and you make a mistake, you can get in and get out with very little harm. You might lose a buck or two on the option. So that's the real key ingredient in liquidity, is it allows you to move in, move out of options without really suffering a whole lot of negative on the bid-ask spread. And there's got to be a bid-ask spread because there's a market maker in the middle that's facilitating these transactions. So there's always somebody to take the other side of the transaction. That's the market maker. This is another point. The closer you are to at the money, the more liquid the option will be. So again, back to our $100 stock or ETF, whatever. those $95 and $98 options, if they have $1 wides and 102s, those are going to be very tight. Now, you get further away, you get up at the 120 or down in the 80 range or something, you're going to start to see those spreads widen out a little bit. And that's what I mean here is the closer you are, the more liquid the option will be. And we're trading mostly options that are reasonably close, normally at least within one standard deviation of the price. And like I mentioned earlier, the bid-ask spread of an option is also an indicator of liquidity. The tighter that spread, the more liquid that stock or that option is on that stock. It's really simple. Again, the bid-ask spread is an important thing you want to look at. You'll notice as you trade options, when the market opens in the morning, you'll see even on the ones with tight bid-ask spreads, the very liquid products, you'll see some very wide spreads. And so you don't ever want to be in that position that you've got to make a trade first thing in the morning or really at the end of the day, because they'll let those spreads widen out and the market makers will really take advantage of you. I'll talk a little bit about volatility in options. It's such a key component, and volatility measures the amount by which an underlying asset is expected to fluctuate a given period of time. Let me simplify that for you. Let's just say hypothetically that the volatility on a $100 stock is 20%. So that means that 20% of 100, which is $20, that's the expected move for 1 year. Now that's plus $20 and minus $20. So the anticipated range on that stock, based on the volatility at that given point in time, is $20. So the range is going to be 80 to 120. And that's really what volatility tells us what the expected move is. And I'm not going to go into detail now. We will in the standard deviation course as far as how to calculate it, because obviously we're trading in shorter periods than 1 year. But just keep in mind that the volatility tells you how much that product should fluctuate, how much, what that range should be in a given period of time. And as a side note, you'll see a reference to different Greeks in trading options. Vega is the Greek for volatility. Now, there are two basic kinds of volatility. There's implied and there's historical. Now, implied volatility is the one we make our trading decisions on, and it's the projected volatility calculated by the market price of the option and using an option model like Black-Scholes. You may have heard of. There's a number of option models. That's one of the most widely used is a Black-Scholes. And of course, because we don't know where this option or where this asset's going to be in the future, typically the implied volatility is somewhat overstated, and that is our edge in trading, particularly in selling options. The fact that we know that implied volatility is typically a little overstated because you've got that unknown in the future. And you'll even notice it more when a stock gets close to earnings. You'll see that volatility just really ramp up, and it might normally be 20, 30%, and all of a sudden now it's 100%. And that's because that unknown is out there, and that volatility just rapidly expands. And then conversely, after the unknown comes out of it, you'll get the collapse, like sticking a pin in a balloon. Now, historical volatility, that's simple. That's either actual statistical volatility. That's where the volatility really was. They might have projected the volatility to be 20%, and actually after the time passed, the volatility turned out to be 18% at that point in time. So historical is the actual or the statistical volatility. Now, if the premium of an option increases without a corresponding change in the price, the options implied volatility have to increase. So if you remember earlier, I mentioned the components of the volatility pricing or option pricing are the price of the underlying. You've got interest rates, you've got time, and you've got volatility, and there's a couple of other ones, but those are the main components. And price can stay steady, but if the volatility increases, the price of that option is going to go up. Conversely, if it decreases, the price of the option is going to go down, even with the underlying price staying fixed. And that's why I talked about, when you've got an unknown event out there in the future, you'll see an expansion of volatility. And once the unknown event is no longer an unknown event, you'll see the contraction of volatility. Now, I want to talk a little bit about the consistency and the discipline, really the keys to trading success. Number one is consistency in your trade strategy. Trade strategy criteria. And the great part about trading option is you can really pick your own winning percentage. I mean, some people like higher winning percentage. you're going to get a lower reward. Some people like almost the 50-50 shots to get a higher reward, but they're 50-50. I kind of spend most of my trading life in that 70% probability of success. So I'm, in most cases, I'm risking 70 cents to make 30%, but my probability is somewhat higher in by the other means that we execute trades and manage trades. That makes a difference. But the thing I want to point out is consistency and strategy criteria. It's not this time do trades that have a 10% probability of profit, and the next time you do one with 90, and the next time you do one with 50. Find a range that you're comfortable with. And I kind of settled in that 2/3, 1/3, 67-33 area. And, it gives me enough premium to handle losses. And I used to trade in that 90% range, and that's great. You go on, and all of a sudden you have a month, and it just wipes everything out. But just be very consistent in criteria used in your strategies. Secondly, consistency in risk and trade size. Extremely important. If you trade a 20, 30,000 or whatever size account, $10,000 account, and you're trading you're just trading one lots at that point. But as your account gets bigger, you want to ramp up the number of contracts. You want to go from initially you're trading all one contract lots. Now you don't all of a sudden think you know something. You trade 10 on XYZ company. You start to, as your account size grows or you put more capital in the account, you want to go from trading one contract to 2 or 3, but keep that risk and that trade size consistent. And the other thing that is extremely important is the consistency in how you manage the trades. I have specific criteria I use. I make it as mechanical as I possibly can. That little guy that sits on all our shoulders and tells us the wrong thing to do, our subconscious mind, you've got to battle him a little bit. But as the time goes on, if you can develop consistency in your trade management, I typically manage trades, put on trades with about 45 days to go. But when they get down to 21 days to go, in other words, I've been in the trade, say 24 days. Now, obviously you can't put every single trade on with 45 days to go, but that's kind of my sweet spot. When it gets down to 21 days, I make it a decision, and I make it really easy. And if I'm in a trade and it's either a break-even trade or slightly profitable, or it hasn't met my profit goals, I'll still take it off. If it's a trade that's a loser, it's been a loser since the day I put it on, I'm just going to stay in the trade. But I'm consistent in that, and I'm consistent in not losing trades early, and that's what I mean by trade consistency and trade management. I just put this little bulleted there because discipline and consistency in trading is a winning combination. I think you have to have both. Be consistent in the 3 points that I said earlier, and then be disciplined. And if you have discipline, that is a key. The two of those together is a key to a winning combination in trading. Now, the problem with discipline, I think, when we see that word, has got a negative connotation. And I question, is that due to our parents, our teachers, or school administrators, maybe our minister or priest that always telling us, always disciplining us. If we did something bad, we go to the office or sit in the corner or have a timeout, or whatever the punishment is, and hopefully it's not something serious like going to jail. But the fact that the word discipline has a negative connotation, and I want you to not take discipline in trading as something negative, because it's not negative in trading and investing. It's just the way, it's just being structured and being consistent and being disciplined. That's really the only way I can explain it. It's just, I don't want you to look at discipline as negative. Oh, I don't want to do that because I'm not allowed to do that or something. That isn't what discipline's all about in trading. It's finding that straight criteria and however you develop your core trading methodology, but being disciplined to stick to your knitting, what Grandma used to say. Now, discipline, I call it a method of thinking and controlling your approach to trading and investing. And it's as simple as that. It's just a way, without that negative connotation, I want you to think of, when you think of the word discipline in your trading, just as how I think and control my approach to trading and investing. Now, discipline in trading is have a consistent and methodical system that can be repeated. That's a huge key. I bounced around for years and years and came upon, probability-based trading about 8 or 9 years ago, and I began to implement that. And, like we all have our growing pains in that, but I have a system now that is very consistent, very methodical. I know what's going to happen. It's just like if we flip a coin 5 times, you might have 5 straight heads or 5 straight tails. But if you flip that coin 500 or 1,000 times, you're going to begin to get closer and closer and closer to 50-50. We can make the same illustration with dice or with cards or whatever, but you need a system that is consistent and methodical, that you can repeat and rinse and repeat, do it over and over, day in and day out. Well, that wraps up this presentation. I hope you picked up a few nuggets from it. If you have any questions, please don't hesitate to give me a call or reach me in Skype. Reach out to me at the website. If you're a member of our trade room, look forward to seeing you. Be happy to answer any questions. But I want you to have a great day, good luck, and great trading.